Venture capital firms pour money into startups years before those companies ever turn a profit. So here's the question a lot of people never think to ask. How do these investors actually turn that paper wealth into real, spendable cash? The short answer is that the IPO is the starting gun, not the finish line. Lenskart listed on the stock exchange on November 10, 2025, and that single event kicked off a much longer process that we're about to break down. Before we get into Lenskart specifically, let's define what we mean by a VC exit. An exit is simply the moment a fund converts its private, illiquid stake in a company into cash or into shares it can freely trade. There are three common routes. The first is an acquisition, where a bigger company buys the startup outright. The second is a secondary sale, where shares are sold privately to another investor. And the third, which is our focus today, is a public listing, where shares are sold on a stock exchange. Let's ground this in the real numbers. Lenskart raised more than $1 billion across 19 funding rounds before going public. It listed on November 10, 2025, and by early to mid-2026, it was trading around a $6 billion market cap. The key pre-IPO backers included SoftBank Vision Fund, Temasek, Kadara Capital, Kairati Ventures, TPG, and other investors like Alpha Wave and SteadView. Step 1 in the exit process is the IPO itself, and specifically something called an offer for sale, or OFS. Many IPOs bundle two different things together. There are fresh shares, which raise new capital for the company, and there's an OFS, which is existing shares that early investors sell directly to the public. Here's the flow. The VC or PE fund holds its pre-IPO shares. A portion of those existing shares are offered as part of the OFS. Public investors buy those shares on the exchange, and the cash from that sale goes straight to the fund, not to the company. That's an important distinction. Money raised through an OFS does not fund the company's growth. It's simply an early investor cashing out part of their stake. Step 2 is the lock-in period, and this is where things slow down. Regulators require pre-IPO shareholders, including promoters, anchor investors, and PE or VC backers, to hold on to their remaining shares for a set period after the company lists. Why does this exist? Three main reasons. First, it prevents a flood of selling, stopping early backers from dumping huge blocks of stock the moment trading opens. Second, it protects retail buyers, giving new public shareholders a stable price before big holders are allowed to sell. And third, it builds confidence, signaling that big investors aren't running for the exit on day one. But here's the key point. Once that lock-in period expires, those same shares become sellable for the first time, and that's exactly when the real exit activity begins. Let's see how that played out with Lenskart. The company listed on November 10, 2025. About 6 months later, the lock-in window was ticking down. Then on May 8, 2026, the lock-in expired, and a block deal worth 5,313.58 crore rupees hit the market almost immediately. Just a month later, in June 2026, a further block deal worth 2,873 crore rupees, representing 3.25% of the company's equity, followed. Interestingly, Lenskart's shares even dipped about 4% in early May 2026, purely on speculation that big holders would sell once the lock-in lifted. That dip was essentially a preview of the exit itself, priced in by the market before it even happened. Which brings us to step 3, block deals, which are really the main event when it comes to actual exits. Once investors are free to sell, they rarely dump their shares onto the open market, because that would crash the price. Instead, they use block deals. These are large trades that are pre-negotiated with a buyer and then reported to the exchange after the fact. Compare the two approaches. Open market selling means small trades over time. It can crash the price if the size is too large, and it's fully visible to every trader watching the ticker. A block deal, on the other hand, is one large negotiated trade, where the price impact is largely absorbed by the buyer, and it's only reported after execution, not before. In Lenskart's case, SoftBank, Kadara, and Temasek used exactly this route to convert their stakes into cash quietly, in bulk, without tanking the stock. Now here's a fair question. Is all this selling a bad sign, or is it just normal business? There are two ways to read it. The bearish read is that some analysts pointed out Lenskart was trading near a rich valuation, with a price-to-earnings ratio around 75 times in early 2026, and they saw the fast, full exits by early backers as a signal that insiders viewed this as a peak rather than the beginning of a longer growth story. The practical read is a bit more measured. VC funds typically operate on an 8 to 10-year life cycle, and their own investors, known as limited partners, are waiting for returns. Selling after a lock-in period isn't necessarily a verdict on the company at all. It's often just the fund doing its job and returning capital on schedule. Let's zoom out for a second, because Lenskart isn't an isolated story. 2025 was actually a record year for venture capital exits in India. According to the Bain & Company and IVCA India Venture Capital Report for 2026, Indian VCs pocketed close to $2 billion from IPO exits that year alone. Funds like Peak 15, Tiger Global, Temasek, Excel, and Elevation booked strong returns across roughly 8 startup IPOs, including Lenskart, Grow, Urban Company, and Pine Labs. And here's a striking stat. 90% of total 2025 VC exit value came from IPOs above $100 million, up from about 70% the year before. In other words, big listings, not small individual exits, now drive almost all VC liquidity in the ecosystem. So let's bring it all together. A venture capital exit after an IPO typically unfolds in 4 stages. First, the IPO or OFS, where a slice of existing shares is sold to the public as the first partial cash out. Second, the lock-in period, where remaining shares are frozen for months to protect price stability. Third, block deals, where once shares are unlocked, big holders sell in bulk through negotiated trades rather than on the open market. And fourth, the fund cycle itself, which reminds us that this is often just a fund returning capital to its own investors, not some verdict on whether the company is doing well or poorly. And that's it. Now you know how the money actually comes home for venture capital investors after an IPO. If this breakdown helped make sense of headlines like block deals and lock-in expiries, hit like, subscribe for more finance explainers like this one, and drop a comment with the next company you'd like us to break down.